What's up, guys? Hamid Talks podcast here, episode number 2. Thank you guys for tuning in. Last week's episode did phenomenal. It was really, really awesome. I've never done anything like that before, and it's awesome that it worked out really, really well. And I'm blessed and glad that it helped you guys. And once again, just thank you guys for all your love and support. In today's video, we're basically going to talk about this misconceptions that people have about trading. All right. So obviously, a lot of you guys are already making a lot of money. We're already making a lot of money together. But we have to be cognizant that not everyone is in tune with this game that we're playing, essentially. So we basically have to talk about the basics. All right, so let's start talking about the basics. I'm going to talk about pension funds, maybe some more detailed stuff as we go along in the video, and then we're going to end it off with some question and answers. All right, so let's start off. Number one. What's the difference between trading and investing? Okay, so trading, obviously. So number one, before we even start talking about anything, right? Our main goal, whatever we're doing with the stock market, is to make money, all right? It's not to sound cool. It's not to sound smart. It's not to look smart. It's not to be able to like post your commentary on Twitter and sound very sophisticated. At the end of the day, the bottom line is how much money are you making? Are you making money with this or not? And then it's to maximize it, all right? So let's talk about the difference between trading and investing. Trading, there are many different strategies to trade. You can trade in the short term. You can trade holding a few days or a few weeks. But essentially what trading is you're buying an asset or a stock for X amount of price, and you're selling it shortly thereafter, relatively shortly. So it can be for a few minutes, a few days, a few weeks, a few months. That's the difference with trading. So trading, short term, you want to try to flip your money quickly. That's the basic premise. With investing, let's talk a bit more about investing, all right? Say, for example, you are making $80,000 a year, all right? After taxes, after your expenses, you might have $500 to $1,000 a month extra afterward, right? And then you've been told through banks and stock market and, oh my God, people on Wall Street, they say that, you should be throwing certain amount of money into the S&P 500 or mutual funds or some sort of ETF to see your money compound year after year. And basically what you would do with that $500 or $1,000. Look, so I'm going to sound very, very, I sound sarcastic, but at the same time, I'm sharing this to try to make everyone money, right? That's the goal. And I just sound like that because investing is not for everybody. So I'm going to explain. If you only have $500 or $1,000 a month, and one of the ways to make money with investing is called dollar cost averaging. Dollar cost averaging means every single week or every single month, regardless of the price of whatever it is you're investing in, you're going to automatically blindly just throw money into it because you think over time, any dip that you might have for X amount of months will eventually average out and you're going to end up making money afterward. Let me tell you the problem with that. Say, for example, you have only $500 or $1,000 and you've been told to dollar cost average into the S&P 500. If you've been told to dollar cost average into the S&P 500 during a bear market, when do you think you're going to see the return on that money? It could be very, very long. Do you understand? So it's not your fault. We are not told. That's the problem with the industry. We're not told how to become financially independent. The industry at the moment is running off of its own mediocrity. So basically, money managers, fund managers, people that are wealth managers at banks, et cetera, they are comfortable because if they're not performing, for example, if you you have a wealth manager or something. Their ticket, basically their get out of jail free card is, oh, the S&P, the stock market itself is red for the year. So yeah, we're red for the year. It's, if you are managing your money on your own, and if you put a little bit of time and effort into understanding how to manage your money properly, it's very difficult to have a red year. Yes, you could have a red year, but the more work you put in to understanding what it is you're doing and where your money is going, having a red year is actually very difficult, as crazy as that may sound. So that's obviously where we want to get to, right? But even then, right? So I'm going to wrap up my point, but investing with a small amount of money is very, very difficult. It's not really worth it. And dollar cost averaging into the stock market is very counterintuitive during a bear market, because the prices are not going to bounce. When you're trying to manage your 401ks or manage your retirement funds, et cetera, that is a different story. But if you're trying to start off by just trying to dollar cost average into the S&P 500, it's very, very difficult, and you shouldn't be doing that. So basically with trading, you're trying to flip short-term money. With investing, you are long-term investing. You aren't looking to take out any capital anytime soon. So obviously, if you have $500 to $1,000 extra per month with trading, you can obviously get a return on that money in a very, very short amount of time, which is why it's so enticing, especially options trading. When you can manage your money properly and you can discipline yourself properly, et cetera, trading becomes so much fun, and trading becomes much easier because you can have a system behind it. But before we, go into the details about that, basically I want to talk about, the difference between trading and investing. But now we can talk a bit more about the specific trading styles. So the one trading style that we partake in all the time is scalping or day trading. So day trading is, I'm sure you guys have watched the stream, right? This is for people that have never heard about me. With day trading, you are entering and exiting within the same day. Oftentimes this happens within a few minutes. So you are buying and selling very, very quickly. That works very often, especially with smaller accounts. With the guys that only have a few $100s basically to invest per month, you're better off trying to trade with that if you can do it properly. Then you are investing longer term, hoping that you get a return. Because at the end of the day, like, most people would rather throw money like in the casino or try to make some money like short term. There's no one is willing to long term dollar cost average into something and hope for 5-10%. It doesn't work. And please just don't do it. There's no point right now, especially in a bear market. Just wait for another huge leg down and then buy calls for like 10 years out. But yeah, aside from that, let's go back to day trading. And the different trading styles. Day trading is when you buy and sell within the same day. Swing trading is when you buy and you hold for at least one day. So say, for example, it's Monday, I'm buying something, and I think by Friday it's going to have a certain price. So I buy on Monday, hold. The move happens, and then I sell on Thursday. That's swing trading. With both of these methods, coupled with options trading, the amount of money and the returns that you make are preposterous if it's done properly. All right. So essentially, those were the two main types of trading styles, right? But now we should talk about the different types of analysis. So there's technical analysis and there's fundamental analysis. Both are needed but one is more important than the other when you're looking at time frames. So, for example, when we're day trading, right? When we're looking at very short time frames, technical analysis is king. When we're looking at very, very longer term time frames, fundamental analysis is king. Okay? So let's start off with fundamental analysis. First of all, everyone that's watching this, you guys already understand all of the technical patterns. You guys already understand technical analysis. You guys understand charting, indicators, all that good stuff. I would highly, highly recommend everybody, please take an intro to Econ 101 and take an intro to Accounting 101. Okay? That is going to give you a solid foundation to understand how to read the books, because fundamental analysis is basically that. Okay? So that's a large portion of it. Fundamental analysis. Basically, there's three main important principles within fundamental analysis. And let's go ahead and basically try to explain all of these different things. So there's three things: the income statement, the cash flow statement, and the balance sheet. Okay? The income statement, there's three main ways, basically statements that you look at to see the inside of a company, to see how the company is doing. Those three things are called the income statement, the cash flow statement, and the balance sheet. The point of the income statement is to basically calculate the net income of a company. Okay? So we're going to Apple. All right. I'm going to look at the income statement of Apple. How much money is Apple making? Cool. Figure that number out. We're going on to the next, which is the second statement, the cash flow statement. So we're using the number that we got from the income statement, and we're putting that number into the cash flow statement, and we're using that number to basically calculate how much operating cash the company has, period, right? Once we get that, then we use that data to calculate what is in the balance sheet. So the balance sheet is the overall how much the company is worth, period, point blank. Okay? That is very, very fun to understand, to look at the nuanced details behind companies, how certain companies are. There is a lot of numbers that go into this. All right? And fundamental analysis can get very, very detailed, because based off of just these numbers alone, based off of the income statement, the cash flow statement, and the balance sheet alone, there are a lot of things that companies are basically telling you about them. All right. And aside from that, there's so many different other things. The price per earnings. I'm sure you guys have heard PE ratios. Oh, you should only invest in companies that have 15 to 20 to 25 PE ratio. Oh, if a company has more than 40, 50 PE ratio, you're basically, for every $50 you're investing, you're only getting $1 back, blah, blah, blah. Get very, very detailed. The debt to equity. And then you can really start to understand Warren Buffett and Benjamin Graham's way of valuing companies using fundamental analysis. It gets very, very detailed. Not only that, aside from the three statements, right? Fundamental analysis is also trying to understand how the company is as a whole. All right. So you also need to look at who is in charge of the company. Who is the CEO? Who is the team in charge? Who's on the board? Who's the people calling the shots? Who invested in that company? Okay, this VC invested in the company. All right, cool. I want to see what other companies that VC invested into. What is the track record for that VC? Basically, you're trying to follow the money at every single stage. That is the point of fundamental analysis. And if you're good at it and you can connect the dots and everything, you can understand, oh, wow, this company just invested in this company. That means that they're going to use that as leverage to try to basically look at another company, and they're going to make both of them work together. So it becomes very, very fun, especially when you're looking at things on a longer term horizon. And if you can connect the dots well enough ahead of time, then you're golden. That's awesome. And yeah, man, fundamental analysis is very, very fun. You basically just look at how well all of the operating cash flow and how well the company is basically operating, quarter to quarter, year to year. You need to see who's running the business. You need to see the macroeconomic factors of what's going on, and the overall horizon for the next 5 to 10 years at least, right? That's fundamental analysis. And that is used on a much longer term horizon. Technical analysis is the much funner thing that we all are used to and we all do, basically. Technical analysis, we're using charts, we're using patterns, we're using pattern recognition. It sounds much cooler and it's fancier, and it's fun because we actually tangibly make money in the short term when we learn this. So the thing is that there is a stigma in the industry with people who just follow technical analysis. And at the end of the day, you should not care about stigmas associated with anything. You should try to learn what it is that you, regardless of what other people are saying. If someone is making money doing something, technical analysis purely, right? Why don't you just have the open-mindedness to be like, okay, maybe I don't know everything. Let me see what this person is doing. But there are people in the industry that are very, very good at fundamental analysis. And the only thing that they lack is basically execution. So a lot of these people, they are, not only they're lacking in the psychological aspect in terms of being a trader and they don't want to take the risk. But some people, they also just completely shun technical analysis because they aren't good enough to understand how it works. And it's crazy because a lot of industry leaders also say that technical analysis is wrong. But then on the other hand, you have entire funds that are meant to high frequency trading. They use technical analysis in their day-to-day trades. No one is scalping based off of the PE ratio of a company. Okay? So all of these companies that are high frequency trading, they're trading day-to-day very, very quickly. They're using technical analysis to see different levels, and they're buying based off of different levels and different indicators. So if people are, I think we're pretty past that as an industry. This was more relevant maybe like 5 years ago. 5 years ago, if you're just entering basically the trading sphere within the past 5 years, you probably haven't dealt with this as much. But there was a huge stigma to just understanding and learning charting, which is unfortunate because people could have made a lot of money if they just focused on learning how to chart as well. All right. But yeah, the main point with technical analysis, the main point with fundamental analysis is you need to have both. If you don't incorporate both into your trading, then you're basically naked to one half of an analysis. And you never want to do that. You always want to have your arsenal full of weapons, basically. This is a terrible analogy to use, but I mean, it is what it is. We can't stop it now. But basically, you want to have multiple, like you want to be able to attack the market in different ways. You want to understand how the technicals are looking. You want to understand how the company is doing. You want to understand, okay, this leader of the company has had prior experience with running successful businesses. The people that are backing this company have also had a good track record, et cetera, et cetera. You've done your due diligence with the chart. You've done your due diligence with the fundamental analysis. Now you're ready to make a good trading decision. But yeah, so now just understand, shorter time frame, technical analysis is king. Longer term time frame, fundamental analysis is king. To be very, very good, you need both. So definitely I would really, really recommend everyone take an intro to accounting and an intro to economics courses, because you need both. And it's also basically very, very, with this in mind, right? You basically have to understand that it's very, very possible to beat the market. To say that you cannot beat the market is a form of laziness. I'm going to say that again. If you claim that you cannot outperform the market, you are justifying your mediocrity. If you've been told by money managers, I was saying this in the beginning, if you were told by money managers that, okay, yeah, you're going to have a red year for the year, the markets are doing bad, blah, blah, blah. If you have enough understanding of technical analysis and fundamental analysis, you would be able to manage your portfolio well enough to position it not to lose money. And once you do spend some time to learn, it becomes actually difficult to lose money for the year. To lose money over the course of a year, you have to make very, very bad decisions. And at first, we all make bad decisions. It is what it is. You have to make mistakes early on with your trading. You're not going to become perfect. You're not going to be perfect overnight. You can be surrounded by all the best traders in the world, and then you'll still make a mistake. That's a part of the game. Do you understand? That's one of the crazy things about humans as well, is because oftentimes, I know this for a fact about myself as well, oftentimes we end up being more disciplined, and then as soon as things become easier, for example, if I was a part of a Discord where people were millionaires and making a bunch of money, I might end up just being less disciplined in my trading, because I know in the back of my mind, I have all of these guys that I could always just follow them. If I make a mistake or anything like that, I'll be fine. I got these guys in the Discord. That is understandable, but it's not a good way of thinking. And I know for a fact there is a good portion of people that think that way. But that's the thing. You cannot be comfortable. Mistakes happen. That's 100% fine. You're going to make mistakes. But you can't deliberately make more mistakes than you would normally. That's the point. So don't join the Discord. Don't join a good trading community and then make more mistakes than you normally would, because you're around a bunch of people that will basically help you after you make the mistake. Try to force yourself to be even more disciplined and execute even better. All right. Yeah, yeah, that's good. Sorry. But yeah, so basically, yeah, I think I just made my point. Basically, technical analysis, fundamental analysis. Yeah, makes sense. The other thing. Yeah, so basically the other thing that I want to talk about was recently, now that we basically talked about the overall landscape about with investing, what the difference between trading is, what the difference between investing is, and the difference between technical analysis and fundamental analysis. Now that that's out of the way, I wanted to share some interesting things with you guys about what I've seen basically in the fund space, as well as finding good long-term trades. So number one, it's kind of like completely sort of a different topic, but one of the easiest trades to make is you basically follow what BlackRock is doing. BlackRock is one of the largest funds in the world, right? I think they are the largest fund. They have like over $9 trillion under management. If you get news that BlackRock is investing in a company, and this is the first time they've stepped in to invest in that company, or they're adding to their position with options, you buy calls for 2 years out the money, and you're going to make money. I've basically done this every single time BlackRock enters some sort of position. BlackRock recently entered a few positions this year. They went long the Russell, which signaled some sort of a bottom. The Russell ended up bouncing. They went long multiple different stocks as well. 2 years ago, they went long AMC before the AMC run up. I was already long prior to BlackRock going long. BlackRock stepped in. This was when AMC was trading in the dollars. I had 2023 $5 calls, $9 calls, $11 calls. Back when AMC was trading in the dollars. Those calls ended up going over 40,000%, 50,000%. So BlackRock, you see BlackRock investing in something, you just invest in them, in the company as well. Longer term calls, in my opinion, one of the easiest trades you can make. Number two, we have to understand what is going on with the overall economy and what's going on with the stock market. All right, because another misconception people have is the difference between the economy and the stock market. So the stock market obviously is assets. It's stocks, it's bonds, gold, silver, crypto, all that stuff. You could just throw that into the stock market. The economy, inflation, wages, jobs, cost of goods, etc., etc. So if the economy is doing bad, that doesn't necessarily mean that the stock market is going to be doing bad. As we saw all of 2020, 2021, the economy was garbage, but the stock market was hitting new all-time highs. And the reason for that is because of the Fed balance sheet. Okay? The Fed, the central banks of, so look, listen up, guys. The central bank of every country wants to make sure that the stock market of that country does not fail. Let me explain why. Put myself in a very tough position to answer a very mouthful of a question. So basically, there's a bunch of older people, they're retired. Their retirement accounts are invested in XYZ company, okay? Say, for example, the Teachers Fund of New Jersey is invested in AMC. If AMC starts capitulating and going to zero, that fund and every teacher, all of the teachers' retirement funds are also going to go to zero. Say, for example, the Firemen of Kansas Association that is managing the portfolio of all of the firemen of Kansas. These guys invested into some random stock as well. If that stock ends up going to zero, and if the basket of stocks that all of these guys are invested in goes to zero, they would lose their retirement accounts. So obviously the country is not going to allow that to happen. A few weeks ago, we saw that basically happen with London, the UK. The pension funds in the UK were obliterated. They were invested in terrible assets, didn't work out, and essentially the Bank of England had to step in. They had to print money to make sure that the stocks did not fall. Because number one, they are not going to allow the retirement accounts of city workers to fail. They're not going to allow firemen, police officers, teachers. They're not going to allow these people's pension funds to fail. So another thing that you can do is look at what these people and what these funds and everything are invested in. And you can take and you can pick a trading portfolio based off of the stocks that these guys are invested in. Because at the end of the day, if any of them start to go to zero, there's hundreds of millions and billions of dollars also invested in that stock. And it just so happens that, the majority of police officers around the country are also invested in that stock through, the unions and everything that are formed across state lines and everything like that. So you just look at the stocks that the companies are also invested in and understand that the Fed is not going to allow those companies to fail. Because if they allow those companies to fail, then city workers around the world, their pension funds are going to fail. And that's not going to happen. Back in 2020, that was close to happening. What happened? The Fed ended up printing money. That's another reason why I don't know if the Fed is going to basically allow the overall market to just capitulate and get to like a breaking point where we're not going to print more money. The only real way that this is going to be solved, I was saying this a few months ago, the only real way that this is going to be solved is they're going to have to either not print money and force people to live essentially in a very, very messed up semi-depressionary environment. And I don't think that they're going to let that happen. Number two, they're going to have to print money. So either way, I think essentially that's what I think is going to end up happening. If the market does end up showing a lot of weakness, the Fed is going to have to step in. So once there is a lot of weakness, the Fed's going to step in, and they're going to step in a time when people didn't really expect them to. So at the moment, we still, in my opinion, we still have a few weeks of downtime, especially before midterm elections begin as well. I do think that the market can fall lower before midterm elections, and then it would set up the perfect stage for them to rip it to the upside. They, if they would rather have Republicans in power, that's what they would end up doing. So it's going to be interesting. Let's see how all of that plays out. But essentially, the main points that we talked about, basically we talked about the difference between fundamental analysis, technical analysis, this difference between trading and investing. And we also talked about, so basically, when the economy is doing very, very badly, if the Fed steps in and starts printing money, the economy can continue doing badly. But if the Fed prints money, then the stock market is going to go to the moon, basically. The stock market is going to do really, really well. And we've seen that happen for the past 2 years, essentially. So overall, what I would really, really recommend everyone do, understand accounting 101, understand economics 101, understand the balance sheet, income statement, the cash flow statement, learn how to read all of those things. You could find it all online. It's very, very easy and simple on how to do all that stuff. I would recommend learning, trying to understand why debt in a company is relevant. Try to understand the debt to equity. Try to understand the price to earnings ratio, different, like very simple things like that as well. You can learn all of those things as well. I would really recommend you do that. And essentially the difference between the economy and the stock market is going to do, basically once the economy is garbage, once the economy is very, very garbage, then the Fed steps in and prints money and causes the stock market to go up. Because once the economy is very, very bad, all of the pension funds basically are at risk of being liquidated, like we saw with England a few weeks ago. And when the economy is very bad, instead of letting all of the people's pension funds go to zero, they have to print money to let people still have a retirement account. And that is the economic situation that we're currently in. It's a very fun one, but essentially understanding this is good because you could basically profit on either way, and understanding what the game is a part of the game, and you basically need to do that. So now let's take a look at some question and answers. Yeah, basically what I wanted to say was you can invest in the companies that these pension funds are basically invested in because you have the backing of the US government, essentially, because the government is not going to allow these pension funds to go to zero. So there's that. Okay. Question number 1. How do you protect the capital that you've earned through trades? What is the mentality required, and how would one develop themselves mentally to have it? All right, let's start off with this. How do you protect the capital that you have earned through trades? All right, say for example, you start off with a $10,000 account. You've made $1,000 so far. Now you have an $11,000 account. I would only be trading with a percentage of my portfolio. So regardless of how big or how small, etc., my account becomes, I'm always going to be trading at a percentage of it. So I'm not going to make $10,000. So I'm not going to start with a $10,000 account and make 1,000 of it and think, okay, now I have $1,000 of profit to play with. No, I'm looking to turn that 11,000 into more and more money. So now I've turned that 11,000 into 12,000. I'm not thinking that I'm in $2,000 of profit. That's not really the healthy way to look at it, because then what ends up happening is if you end up doing that, which everyone does. Oh, I'm playing with $2,000 in profit. All right, let's make a stupid trade. Let's make a very, very risky trade. I have $2,000 in profit. I can afford to lose some of it. What ends up happening? You end up losing 30, 40, 50% needlessly of the profits that you've just earned. So what I would recommend is don't become overly aggressive now that you've made profits. Stick to the same principle, stick to the same discipline that got you that money to begin with, and then add to it and add to it and add to it. Eventually the base hits accumulated over a long enough period of time. The base hits that you make accumulated after 2 months. Say for example, all you've been doing was 10%, small trades. What ended up happening is you turned 10,000 into 50,000. And then the base hits that you're making with a $50,000 account is basically like a home run if you were using a $10,000 account. That is the power of patience. It's very, very important to be patient. It's very, very important to stay disciplined. So how do you protect the capital that you've earned through trades? I don't even think about it in terms of protecting capital that I've made, right? I'm protecting capital, period. If I make money, cool, it's added to the repertoire, but I continue to trade based off of my overall portfolio. What is the mentality required, and how would one develop themselves mentally to have it? You need discipline. You need to discipline yourself. So at the end of the day, the core premise is you need to make sure that you're only doing things that are good for you. You should not be shooting yourself in the foot. You shouldn't be doing things that are detrimental to you. Depending on how extreme you want to take this, how would one develop themselves mentally to have it? And that it, in my opinion, is discipline. So depending on how extreme you want to be disciplined, you just need a disciplined lifestyle overall. If you're living a very disciplined lifestyle overall, you don't smoke, you don't drink, your diet is on point, your sleep is on point, your exercise is on point. If all of the different other aspects of your life, you're disciplined, then I promise you when it comes to trading, you're also going to be disciplined. Discipline is a muscle. You need to develop it. You need to force yourself to only do things that are in your best interest. Say, for example, you're smoking cigarettes. Smoking cigarettes, you're knowingly doing something that's bad for you, right? So if you're psychologically smoking cigarettes, you're already doing something that you already know is terrible for you, but you've justified it to yourself. The same concept is going to apply to trading. Trading, you're not killing yourself. With smoking, you're actually tangibly erasing years of your life. Trading isn't as bad. So that's why if every aspect of your life is not as disciplined as possible, right? I'm not saying just because you smoke cigarettes, you're going to be a bad trader. It's not the case. Everyone is smoking. I mean, most people will smoke cigarettes at some point in their life. That's fine. But the main point is how extreme you want to take it. If you're disciplined as hell in every other portion of your life, and you can be, and it's very possible. You could be more disciplined than everyone that you know overnight. It takes time, but you can choose to be disciplined and it can occur. But basically, you need to work up to it. If you're disciplined in every other aspect of your life, you'll basically be a better trader because you can control your impulses. You'll be able to take control of your actions properly. You won't allow your impulses to control you. So yeah, definitely would work on discipline as well. Number 2 question. Hamid, do you meditate? So, yeah, I meditate every morning. So as soon as I wake up, I meditate. I do a breathing exercise. Also, because I'm Muslim, basically we pray 5 times a day. So I guess that is also a form of meditation. What the point of basically my meditation, especially praying for Muslims, is meant, so as we're praying, right? So you don't need to be Muslim, but obviously what we're doing at the time of our prayer is we're only focusing on the prayer, right? So while we're praying, we're not supposed to think about anything else. We're just literally supposed to be in the moment, just focusing on the prayer, right? So if you are reminding yourself to do that 5 times a day, regardless of if you're praying to a God or not, whatever, if you're sitting down and you're reminding yourself, okay, I need to be in the moment and be present in the moment. And one of the most tangible things that I like to give as an example is like, say for example, you're eating, right? You're eating food. Focus on every single bite that you're taking. So when you take a bite, you're cutting it up. Focus on the taste on your tongue. Focus on how it feels in your mouth. Focus on how everything, the smell. Focus on the exact moment of, consuming that food, right? And take that same principle to everything that you're doing. Say, for example, you're working on your car, right? You're under the hood and everything like that. Focus on exactly what you're doing in that moment. The Romans would say, act like a Roman. Focus on exactly what you're doing in that moment. Like they would attribute being present in the moment to being a Roman man. I think that's what they would attribute it to. So once again, one of the easiest ways to be present in the moment, just think about while you're eating, focus on the food. Focus on every bite that you're taking. Focus on the taste, smell, everything. And then basically you understand how that feeling is mentally. You understand how that feels putting your body in that state, right? And then you basically just apply that same thing to trading. It's going to sound very weird, right? But I promise you, the next time you're eating, do this. It's going to make the food taste better. I promise you. And if you can, this is also a muscle, right? It takes time to try to be present in the moment and to try to control everything that's going on up here in our minds and everything, because it's very easy for us to think about the past, think about what happened last week. Our minds run a lot. And most people, I guarantee you, 99% of people have something going on in their mind. Like most people have something messed up going on with their mind, 100%. Everyone is thinking about a bunch of weird stuff that you shouldn't be thinking about, or they have like weird impulses that we're all trying to control. So that's 100%. Every human is like that. There's no, we we might think that, we're weird, but I guarantee you, like everyone is has something that they're trying to control mentally. That's understandable. But the game is basically who can essentially be disciplined enough to control their minds to focus on whatever's going on in the moment for as long as possible. So if you can remain in the present moment and you can be disciplined and focus on exactly what you're doing for years, that puts you on an entire different level. And basically it's very important. I would really, really recommend everyone do that. Athletes take this very, very seriously. And as a stock trader, you are basically doing something that 99% of people in the world can't do. You're embarking on a journey that really, really requires a lot of focus. So I would take the same principles and advice that athletes and other people are giving in terms of their craft. You could learn from them and apply it to ours with stock trading. All right, so I would definitely do that. Meditating is very important. Dawn asked a question. Thank you, Dawn. Can you explain good exits and entries? Okay, so number one, since we're in a bear market, it is very, very easy to enter short and basically to enter puts at levels of resistance or enter puts as levels of support are being broken. Those are the two easiest trades to make. And essentially a good exit is going to be something where you are close to a level of support. So if something starts going against you, you have a tight exit point where you're not going to lose that much money. And basically with entries and exits, you need to be very, very patient. I've gone over like a lot of different trades, and you could watch some of the live streams. For example, from Friday, you could see the live stream that I did. All we did that entire time was I think we took one trade, and it was the exact bottom of the day. We went long at around 10 a.m. So we watched the market fall for 30 minutes. It got to that level of support. It was literally the perfect opportunity to go long. We went long and it held. If we had entered 50 cents higher, we would have been stopped out of our trade 100%. So that's why exits and entry, that's why waiting and being patient for your entry point is very, very important. That obviously takes time to understand where to draw out your support levels, where to draw out your resistance levels. That's understandable. But basically, the main premise is you want to be as close to the level that you're going to stop out at. So say, for example, your stop loss is going to be 378. All right. Say, for example, the SPY is at 400. You're going to buy at 400 and your stop loss is going to be 398. Your job is to try to get as close to 398 as possible before going long. Because the people that are managing basically the market makers, they see that, okay, there are X amount of people going long at 400. X amount of them have their stop loss at 398. It's our job to make them get stopped out. So they're going to drop it down to 397.60, 40 cents below your stop loss. And what ends up happening? You get stopped out because it dropped below 398. But if you had waited for 398 and they drop it to 397.60, that doesn't mean anything to you. But a drop from 400 below 398 to 397.60, your initial entry point is very far away from your stop loss level. So your job, the easiest answer is try to get as close to your stop loss as possible before you enter. All right. I hope that answered. The next question was, how do you build discipline? Damn. All right. Well, I mean, I kind of already went over that. I think we should talk about that more in detail in like a different episode or a different video. That doesn't really make sense to regurgitate a lot of that. I think I could do a much better job like outlining my exact detailed explanation for all that stuff for a later video. But for now, I think we've laid out a proper foundation for people in general. The economy is not the same as the stock market. If the economy is doing very, very badly, then the central banks of the countries are going to make sure that the stock market stays up. And the reason why they want the stock market to stay up is because there is trillions and trillions of dollars invested in retirement accounts and funds, essentially, that they don't want people to basically lose their retirement. So it's an entire cycle. So now that you guys understand that the economy and the stock market are different, now that you guys understand the difference between technical analysis and fundamental analysis, and you guys understand the difference between trading and investing, I think now, unless there are other principles that I can talk about in the later episodes, I think now we did a pretty good job going over like the basics. So yeah, overall, I'm pretty happy about what we did so far. If you guys have any questions for the next episode, please make sure to drop them in the comments. This was pretty fun. I think we did a good job. And yeah, definitely. All right, cool. Yeah, I didn't forget anything. Cool. All right. I'll see you guys. Have a good one. Take care.